All right, maybe we can kick it off while we continue to let people in. Today, we're going to be talking about quarterly taxes and your estimates that you pay and why planning is important. This is a recorded session, so people who are not able to attend will be able to get the chance to see it, but it's interactive, and we're hoping to have questions come in to be able to answer questions on quarterly. It's a topic we haven't spoke about before, but it's an important topic, and as a business owner, it's something that you have to consider quarter over quarter. If you have a friend or a business colleague that you'd like to join, I posted the Zoom link in the chat for you to join alongside us, and we'll go ahead and let's go to the next slide and get started. So just before we even get started to talk about the topic of quarterly taxes, I wanted to do a little comparison. We talk about a lot hearing of what the difference is between a tax strategist versus a CPA, and how come my CPA can't do what's already being done? And here's what most people don't get. A CPA is sort of like, you can see this comparison like a regular doctor. You go once a year, they do a quick checkup, maybe they tell you to drink more water, file your taxes, and you're out the door and sort of done. But a tax strategist, that's like having effectively a cardiologist on your team full time. Not only are they looking out for what's going on right now, but especially at Wealthrive, we're planning 10 moves ahead. So we're having conversations with you. Let's move this income. Let's shift ownership. Let's reroute this capital gain through a trust. Let's get your kids on payroll. Let's buy that building in a way that wipes out your tax play. It's not just compliance, it's playing chess, not just checkers. And CPAs are great at telling you what happened, whereas tax strategists, as you can see here, design what's going to happen before the IRS even knows what's coming. So we're looking at your businesses, we're looking at your investments, your estate plan, your retirement, your real estate, and really engineering a tax plan that actually builds your wealth. Because the reality is you don't get rich by playing defense. And I love using the doctor example because you don't wait for a heart attack to call a cardiologist, right? So the question I would ask people as they tune in is, why would you wait for a massive tax bill to finally pick up the phone and call us? And I'm letting people in as they come. But let's go to the next slide, which is perfect as people join, because it explains perfectly what we do at Wealthrive. And I'd like to ask you, Peter, maybe you can talk about what Wealthrive is for people that have not heard about it. And, for the
Sure,
clients and people that have talked to us, maybe talk a little bit about the program. Thanks.
of course. Thanks, Samir. Good introduction. Yes, so high level, Wealthrive is what we like to call a wealth coaching uh, program. It has essentially three parts, one of which we're going to focus on today, which is tax mitigation. Often that broadens out into a broader conversation with clients about other aspects of their wealth management, which is often involves other opportunities for tax savings. And then often a key part of what we're working on is passive income generation. To uncover all these opportunities in each individual case, we follow a methodical, detailed three-step process, which we call discover, design, deploy. In the discover phase, we're going to collect all the information that relates to your taxes and potential tax savings, tax returns, operating agreements, trusts, things like that, and have a conversation with you about that, from which we then pass to the design stage, where we take all that data that's relevant to your taxes and essentially create for you a menu of all the opportunities you might take advantage of, have a conversation with you about the pros and the cons of all of those different opportunities, and from the menu, select the ones that are most suited to your situation and would move the needle most in your sense. So if you're thinking that you might be paying too much in taxes, or wondering if you might pay too much in taxes, participating in this process should uncover some excellent opportunities for you.
Next slide.
So what are estimated taxes? I guess that's a question for today of, how many of you, maybe if you want to post it in the chat, maybe for making estimated taxes, if you even know what they are. Because most people are given vouchers, estimated tax vouchers, when they file their tax return by their accountant. The vouchers have an amount on them. They tell you to pay the federal government X per quarter, the state governments that you have to pay taxes in X per quarter. And we mostly pay them. But for the most part, I've found that entrepreneurs don't know how these amounts are calculated or what they're based on. So if we go to the next slide, I'll share a little bit of the calculation behind the estimated taxes. So when an accountant files your tax return, what they often do, probably in 99.9% of cases, is follow the safe harbor rule. So when they file your 2024 taxes, or if you haven't filed your 2024 taxes yet, you may still have gotten an estimate. What they're doing is looking at your 2024 taxes and figuring out how do you pay 110% of your 2024 taxes in 2025 to make sure that you're not going to pay a penalty or a quarterly estimated tax-related underpayment penalty. So let's just say you paid $400,000 of taxes in 2024. Now your new estimates, they're not going to be $100,000 per quarter. They're actually going to be $110,000 per quarter. That's just, again, assuming your adjusted gross income was over $150,000, which is the vast majority of the clients we help. Now, the other way to not pay a penalty is to pay the government 90% of your current year's tax liability. Accountants don't know what that's going to be. And frankly, neither do most individuals. And as a result, we're all relying on our accountant giving us these 110% estimates. And it's pretty inefficient to just give the government our money unless we really understand what happens if we don't meet this safe harbor rule. And that is really the key to today's presentation, is identifying for you, okay, if my tax preparer is telling me to pay 110% of last year because they don't know what 90% of this year is going to be, what's my consequence for getting it wrong? Because oftentimes in the tax strategies that we're recommending kind of have this philosophy that it's better to ask for forgiveness than permission. And the reason why is because the data supports it. So let's move to the next slide and let's just talk about what happens if you underpay your penalty. Oh, before we get there, if you'd like to figure out how much you could save in your quarterly estimated tax payments, if you scan that QR code and fill out a little bit of information, someone on our team will reach out to you to gather some facts and prepare a custom tax estimated savings calculation for you. So as I was sharing, if you don't pay that 110% or the 90% of this year's tax, the government can charge you an underpayment penalty. So the underpayment penalty is based on a per quarter calculation. What often happens is if you're an entrepreneur, if you're like me, you might be filing your tax return in September or October of the year after the tax year ends. And so you may not even have gotten your quarterly estimates until you file. And when you actually pay your first estimate, it may be September's estimate and you didn't pay your first two estimates for the year. Well, what will happen is the IRS is going to calculate how much you should have paid in the first quarter, or you should have paid in the second quarter, or perhaps should have paid in the third quarter. And they're going to charge you interest on the amount that you should have paid between the time that you should have paid it and the time that you actually pay it. So I would just kind of question for each of you, how is that and what would the ultimate cost be? So right now, the penalty is the federal short-term rate plus 3%, or about 8%. So if you don't make your estimate in the correct amount or timely, you're going to pay 8% in interest. Well, I don't know if that's so significant. For me, I'd rather have my money because I don't want to overpay them. Let's say that your filer, your CPA was telling you to pay $110,000 a quarter. You think you're going to probably end up only paying $50,000 a quarter. Well, give them the 50 grand and let that other 60 grand kind of sit out there. And if it ends up that you owed them that money, yes, you'll have to pay them 8% on that amount. And the other item is you might be charged a penalty. So you want to be sure if you are going to be charged a penalty, how much would that penalty actually amount to? If you're not paying significant estimated taxes because you don't expect a significant tax bill, then the penalty is not going to be significant. But there's also one trick around estimated tax penalties and estimated tax payments, and that's by having taxes withheld from your payroll. So many entrepreneurs, they may receive a W-2, their payroll, in addition to their distributions from their S corporation or their dividends from their C corporation. But if you receive a W-2 in your last payroll of the year, if you withhold the amount of tax that you think you might have to pay to the government will consider all W-2 withholdings as if it were paid equally throughout the year. So that's one of the best workaround solutions, is somewhere between December 15th and December 31st. Give yourself a last payroll check of the amount that you need to withhold in taxes and have 100% of that payment withheld. And now you kept all your money for 12 months of the year, and you're just paying the government right at the tail end. Let's move forward one more slide. Peter, you want to cover this?
Sure. So we wanted to illustrate really the impact of two things. One, the impact of two of the great tax saving strategies we use. I'll describe those briefly in just a minute, which A, reduce your taxes, but B, also significantly reduce the amount of estimated taxes you might otherwise pay. So here's an example of a person living in Ohio, a sort of medium tax state. There are low tax states like Texas, Florida, some other states, sort of medium states. Ohio's one, Connecticut, where I live, is probably one, and then the really big bad ones, California and New York. So in this example, we had a client implement two strategies. One involves the purchase of solar panels, which provide both depreciation deductions and income tax credits, and another strategy, which is a charitable donation strategy. So if that person did not implement any of those strategies, they'd pay about $400,000 in taxes throughout the course of the year, which would mean if they weren't on W-2 and they weren't otherwise withholding, they would have to pay $100,000 every quarter. With the strategies that we recommend, their tax bill goes from about 400 down to about 110, saving them the 286. Those tax strategies aren't free. They don't happen by magic. You have to invest in them. They're often referred to as tax equity strategies. But you'd have a savings in the first year of about $77,000 and a savings over a 6-year time period of about 145. The reason for the 6-year time period is that solar has, as I mentioned a minute ago, a depreciation deduction. Right now, that stretches over 6 years. It may become, in the new tax legislation, all in the first year. So that's a sort of mid-sized, mid-tax bracket state, and you can see big tax savings and quite significant estimated tax savings. So then we show two other examples. The numbers are different, but the methodology is the same. I believe the next one is New York, and we showed slightly higher income, but generally the same trend of numbers, almost 800,000 tax. You'd have to pay 200 a quarter. We'd reduce that to 221, saving almost 600,000. You've got to pay some money to do that, but right off the bat, you got a first year tax savings of the 133 and about 280 over 6 years. If you happen to live in California, which has the highest income taxes in the state, both state and federal, almost 50% if you add the numbers up. If we flip to the next slide, just show the math there. And again, it's somewhat proportional but you can see that there are tremendous opportunities. And all of these case studies only involve two, in the grand scheme of things, relatively straightforward tax strategies. There's some that are even better than these, but you can start to see that not only ultimate bottom line does it save you a lot of money, but as we'll show, I think on the very next slide, it makes a tremendous difference in the amount of money you have to pay in. So these are the same examples, the same quarterly estimates that we calculated, but you can see now, if you calculate the estimate, it's so much less that you have to pay in, which means you're really keeping money in your own pocket to invest in your business, invest in a piece of real estate, as you see fit. So it's really,
Maybe
it's
I'll
turning the,
mention, Pete,
yeah.
that he illustrated in these case studies two strategies. And just about a week and a half ago, we approved a new strategy, which would actually exceed the savings for the two strategies combined that we showed previously. And it's a pretty powerful strategy because it also works for W-2 wage earners, which many of our strategies are really designed for entrepreneurs. But even this year, we have one client that we're working with now with a $30 million W-2. And just this one strategy is going to save him about $3.5 million. So it's pretty incredible what could be done when you apply the right strategy. Now, in his case, he already received the 30 million of W-2 income. And so they've already withheld a significant amount in taxes. But we've told them, don't, cut off the withholdings. You don't need to withhold anymore. And sometimes if you're coming to us in advance of a transaction or something that's going to greatly increase your income, we'll show you how to keep that money in your pocket so that you could use it to redeploy towards this tax strategy and then have the leftover money to, as Peter referenced, invest wherever you see fit for your best rate of return.
And I think that illustrates maybe a little practice pointer. I think a lot of people, even if they learn something about tax strategies, or there might be something I could do to save on taxes. Well, I'm on extension till October, so maybe I don't really need to worry about it. And for reasons both for reducing your estimated payments and because certain strategies work better if done at the beginning of the year, if you're interested in the idea of reducing your taxes, starting as soon as you can on it, you may not have a total final number in mind of what your year-end income is be, but if you at least have a directional number, you can take some action early in the year to get the larger benefit and to get the more significant reduction in your estimated payments. So I think if you go forward too, I think, Tresha.
Great. So yeah, let's open it up for questions. And if you have a question, feel free to type it in the chat, or you could raise your hand. And I think we also have, Samir had gathered some questions from people that had registered but couldn't attend. So we'll be happy to share our answers here and include them in the replay.
Thanks, everybody. So we did have a few questions come in outside of the webinar, but if you do have questions, I can bring you on screen and we can answer them for you. But while we're waiting, if anyone wants to put their question in the chat or raise their hand, we'll bring you on. I will go through one of the questions. So one question that came up, Peter and Noah, is, especially for a business owner that is in a business that could be seasonal or fluctuates significantly, they might be making, even if they're making $1 million for the year, one quarter they might make 100, one quarter might be 400, and then maybe most of their revenue comes in that last quarter. And so the question there is, what should they do if their income is fluctuating and not consistent quarter over quarter?
So when you complete your tax return, your accountant can actually complete a separate form that it reports income by quarter. And that income by quarter is what's used for your required estimates. and for calculating any underpayment requirements. So if you're in the, retail business, e-commerce, and you've got,
Right.
40, 50% of your income coming in that fourth quarter, you can then report on your tax return a disproportionate allocation. If you don't give the IRS the additional information, they're going to assume the income was earned equally throughout each quarter.
Right.
Yeah, that makes sense. And then another question around a specific strategy maybe is, can quarterly tax payments be adjusted to accommodate strategies like QSBS stacking, or is that more of a year-end planning tactic?
So I think I'd say they would we would need to know that to take it into account. QSBS stacking is principally designed to have a client that's owning a business that he's selling, if it qualifies for QSBS treatment, not pay any capital gains tax over 10 million. So if that's only one piece of his situation, we'd want to know about that right at the outset to take that into account. And there are lots of examples like that. You might have a business owner who has a strong income, but he owns a building and the building has depreciation. Well, that goes back to the process I described, which is it may seem like you just fill out a quick form and we plug and play 2 or 3 strategies and you're done. In our process, we really want to look at your overall situation and find the best. There's an interesting thing, those 2 strategies we talked about, solar and the charitable donation. In different situations, in different states, in different tax brackets, a different combination of those 2 strategies is more optimal. So you want to take the time to be thoughtful about how the strategies relate to each other and how the strategies together relate to the rest of your tax picture. And that's what we do in the process.
Yeah, that makes sense. And we talk a lot about the strategy. And at the start of the presentation, I sort of compared what working with a strategist is like in terms of medical terms, going to a general practitioner versus a cardiologist if you had a heart issue. And one question I have is Wealthrive specific. How does implementing our strategies help people on a quarterly basis, given that, one of the things you do, Peter, is meeting with clients quarterly to be proactive, where generally you'll hear a lot of complaints of, my CPA only has time for me once a year, and it's just about how much I owe.
Yeah, I mean, I think that comes up a lot. We were on a call with a gentleman today. So look, it's almost halfway through the year. Most of his compensation, very high earner, unfortunately lives in California, uh, but he's paid some estimated taxes already. But we were able to show this fellow that he doesn't need to make any more estimated taxes. And he probably had this in mind, well, I've written, 1 or 2 checks and I might have to write 2 more. But if he implements the strategies we're recommending, which actually in this case are the same 2 we've been talking about here today, he will not have to write any more estimated tax payment checks. So I would say, but I guess it's a case of early and often, right? Communicate with us early and keep us informed, and we'll do that proactively. But to your point, I love to tell a funny story. We have a client in Idaho, and we asked him when we first met him, well, what's your relationship with your accountant? Well, he says, I go to see her once a year. And we have the same conversation every year. I say to her, do you have a cool strategy I can use to reduce my taxes? And every year she says the same thing, put more money in your pension plan, which just for those of in the audience is not a terrible strategy, but it's not a super great strategy. But what he said was every year when she says that, I brace for impact, which means she's about to tell him that he has to write a really big check. So don't wait until the end of the year. Don't wait until that, once a year meeting. It should be dynamic, ongoing kind of process.
Right. No, that's a story that we hear far too often. One other question I wanted to ask before we close out here shortly is, June 15th just passed. So we actually just passed the quarterly payment that people did just have to make. So For those, whether they're in the audience or maybe registered and are listening to a recording of this, we had about 125 people register. So I want to make sure people that are watching this and saying, well, Peter and Noah, that's great, but I just paid my darn June 15th quarterly payment. What can I do for next quarter to make sure that doesn't happen again? What are some things that we would do at Wealthrive? And are we able to act quick enough before the next quarterly payment is due?
Yeah, I think the idea behind these quarterly estimates, as we kind of outlined in the front end of this presentation, is for the IRS to get paid in line with how you're earning your money. Now, again, if you don't tell them otherwise, they're going to think you earned your money evenly throughout the year. Well, when you do sophisticated tax planning, and as a result, you reduce your taxable income, which reduces your tax, then the quarterly estimated amounts you may have had to pay, which the government, like I said, to safe harbor, they want 90% of this year's tax. So if you've paid in 2 quarterly estimates under the assumption that you were going to pay 100% of the tax recommended by your accountant's tax preparation results, and now as a result of working with us, and you could see through those examples, oftentimes your tax bill is getting reduced by 75%. So if you've paid one estimate, you've probably got 90% in already. Now, if you've paid 2 estimates in, you'll likely receive a refund. Often when entrepreneurs file their returns, by the time they get around to filing and figuring out that they're due a refund, they apply that as an overpayment to their next quarterly estimate. But it may be possible that you won't even have to write a check for 2026 if you've written a check for Q1 and Q2 of 2025, and now you're going to implement your tax strategies. You may be covered not just for this year, but for next year as well.
Right.
Yeah, that's helpful to know, especially given that the next quarter will come quicker than we think. And again, if we look at this slide here, I did attach a QR code where we can give you your new quarterly estimate, much like we did here with our case study and client examples. And you see the differential between paying, 200,000 in a quarterly estimate versus 55,000. And the question I would ask for those either tuning in live or listening to the recording, what would that difference between 255 do for your bottom line in your business, having that, whether it's through money markets or through reinvesting in your business? That's the exact type of work we do at Wealthrive, and Peter and I will send you a free estimate if you scan that QR code and fill out the information. We'd reach out to you.
And I would
So
say part of your question was sort of, if I've already paid a few estimates, is there enough time? And I tell everybody on the call, it's June, whatever it is, 18th. The next one isn't due until September 15th. That is plenty of time for us to analyze your case and tell you if you implement some variety of strategies, how that might reduce your taxes and how that might reduce the amount of estimates that you have to pay.
100%. No, that's great to know, especially knowing that we have that time now. So if we can go to the next slide. So we are having another monthly Thrive Talk on July 22nd, and this one will be a little bit earlier. Today's Thrive Talk was a little bit later. We've been trying different times to see when makes most sense for you guys, the listeners. So anytime you have feedback of what times work best for you guys, we want to make it work for you. So definitely either ping me or post in the chat whenever of times that work best. But we'll be interviewing the founder of Woodland Growth that focuses on highly affluent, ultra high net worth families and legacy planning. And the topic is around if your legacy will last. And so we'll study some of the world's most influential families and how they prepare for succession. And you can scan the QR code or in the chat directly, click the link, and you can join us next month to talk about succession planning. But before we go, this was a shorter Thrive Talk to cover quarterly. Noah or Peter, any closing thoughts from you guys?
Maybe as I mentioned, we have a new strategy that we just approved that enables a taxpayer to deduct 60% of their adjusted gross income through the charitable contribution of gift cards, for which they only have to pay about 12.5% of their AGI. So if you think about a taxpayer, let's say in New York or California with $1 million income, they may pay $500,000 in taxes. Well, here you may be able to get a $600,000 tax deduction, which would save you $300,000 in taxes. and you'd only have to pay $125,000 to invest in that tax equity strategy, thereby generating a return of $175,000 of profit. So again, one simple strategy, one way to generate a very high return on investment and reduce your income tax. So I just want to encourage you, if you're not doing anything creative and you're just sending your money into the government, think about keeping more of that money in your pocket. We'll be happy to help you.
And I think it goes back to
I'll add one thing to that. We haven't really talked about refunds tonight, but some strategies, including the solar strategy that we've talked about, has the potential to give a taxpayer a refund going back up to 3 years. So even if this is your first exposure to this, you may not only be able to reduce your taxes this year, but if you've paid significant taxes in prior years, you may be able to get some of that money back. Again, another reason to not just have a plug and play strategy, but to let us do a thorough analysis of your situation to uncover those other opportunities.
Thanks, Peter. Thanks, Noah. And I'll close it out with how we started. Again, the QR code is here if you want to register for next month. And for those that filled out their quarterly calculator form, we'll be reaching out to you shortly. But the question I'll leave you guys with is just like we said, if you wouldn't wait to go to a cardiologist for a heart attack, you would hopefully want to talk to them prior. And so the same thing is you don't want to wait for a huge tax bill before calling us. We are here to be your proactive partner, not your reactive partner. So thank you guys for joining.
Thanks for having
Thanks,
us.
Samir. Thank you.
See you guys next month.
Everybody.